If you're trying to figure out how to invest your money today, you are probably drowning in noise. Between the online gurus pushing crypto and the endless ads for new trading apps, it is entirely overwhelming. In 2026, building wealth is mechanically free. Pretty much every major app offers zero-commission trades. But strategically, it's paralyzing because there are simply too many competing options. Choosing the wrong asset class or platform for your specific financial phase often does more damage to your long-term wealth than picking a single bad stock. Building real wealth doesn't require complex day trading. You just need to pair the right platform features with a disciplined foundational asset strategy. This chart shows what we call the 2026 Wealth Stack. It's a framework that categorizes your investment options based on how much capital you have to invest versus how much effort you actually want to put into managing it. Down here in the bottom left is Phase 1, the foundation. This is the low-capital, low-effort zone where you stick to basic index funds and beginner-friendly apps. Moving into the middle zones introduces international diversification, REITs, and premium subscription features. Finally, in the top right is Phase 3, the alternative seeker. This is a high-capital, highly illiquid zone focused on private credit and alternative assets. Skipping ahead to a higher tier before your foundation is solid is a fast way to get trapped in assets you can't sell or lose your gains to subscription fees. Let's start at the bottom. Phase 1 targets the paralyzed starter. If you have anywhere from $100 to $5,000 to invest and you feel intimidated by market mechanics, this is where you start. You want a platform that offers high support and educational guardrails. Brokers like Plink and SoFi prioritize this, keeping the interface clean and focusing on teaching you the basics of a trade. Your asset strategy here is incredibly straightforward, buying a total U.S. market ETF, like VTI, and a bond ETF, like BND. Because these platforms offer zero-commission trading, every dollar you deposit goes straight into the investment. A single share of VTI instantly gives you exposure to roughly 3,500 U.S. companies, including giants like Apple, Microsoft, and NVIDIA. You don't have to pick the winners because you own the entire market. This chart shows exactly how cheap this is to maintain. VTI has an expense ratio of just 0.03%. Compare that to a traditional financial advisor who might charge a 1% annual fee. Over decades, that gap is what builds your wealth. The trade-off is that you are sacrificing advanced analytical tools, and you won't get premium interest rates on your uninvested cash. But Phase 1 is about building an investing habit with zero friction, not about squeezing every last percentage point of yield out of the market. Once your portfolio crosses the $10,000 threshold, your needs shift. Having uninvested idle cash sitting around doing nothing becomes a financial liability, and relying entirely on the U.S. stock market leaves you exposed to a single economy. This is when you look at subscription tier models, like Robinhood Gold for $5 a month, or Public Premium for $10 a month. These subscriptions provide 5.4% interest on your uninvested cash and 1 to 3% matches on your IRA contributions. Your asset strategy expands here too. You start diversifying outside the U.S. with an international ETF like VEA, and you add real estate exposure through a real estate investment trust, or REIT, like VNQ. REITs are powerful because they give you the inflation hedging benefits of owning physical property, like these residential buildings, without the work of a landlord. The major trade-off in Phase 2 is that monthly subscription fee. It creates a permanent mathematical cost drag on your account. This chart calculates your actual break-even point. If your cash balance isn't high enough to generate more interest at a 5% yield than your annual subscription fee, you are actually losing money. Phase 2 requires you to actively calculate your returns. You have to ensure the platform's premium costs are genuinely justified by the size of your portfolio. Phase 3 is for advanced, accredited investors with well over $100,000. These are people who have maxed out their traditional accounts and need alternative assets that don't just move with the stock market. One of the main vehicles here is private credit, like the Fundrise Opportunistic Credit Fund. Instead of buying stocks, you are acting as a lender to real estate developers. The appeal is the target annualized returns of 9. Chasing an 11% yield in private credit is a categorical mistake if you don't even own a foundational U.S. index fund yet. You have to build from the ground up. This flowchart maps out exactly where you should start today, based on your capital and your goals. The first question is simple. Do you have under $10,000 or over $10,000 to invest? If you are under $10,000 and need educational handholding, start with Plink and buy VTI and BND. If you want to operate more independently, go with Public and add VEA to the mix. If you are over $10,000 and your main goal is getting yield on idle cash, upgrade to Robinhood Gold. If you are already established and seeking yields outside the stock market, look into private credit. Look past the marketing of free apps and guaranteed returns. Understand how these platforms actually make their money, because the financial industry is built to generate profit off your transactions and your subscriptions. No matter the platform or asset class you choose, all investing involves the risk of loss. Adding complexity to your portfolio often just amplifies that risk. The most effective strategy is the one tailored to your specific psychology, the plan you can actually stick to for the next decade, regardless of the mathematical yield.